Hi, my name's Caleb. I am a co-founder of a company called Blocklytics. We look at on-chain data, and I've been analyzing Uniswap for probably the last 9 months or so, and I've been having great fun doing it. So each week, I send out a newsletter called the Uniswap Report. Unfortunately, I don't have a good shareable link for it, but if you look on Twitter, you can find the link. And basically, in this report, I break down kind of the protocol stats, what news is going on on the project, and then I look at the top exchanges and look at them based on their liquidity and their trading volumes and the amount of traders that they have. But we'll go into a little bit more detail about Uniswap. So just to get an idea, how many of you guys have used Uniswap? Yeah. And have you guys tried out pooling as well as swapping?
Creating liquidity pools.
Yeah, very cool.
Yeah.
Creating them. So.
Oh no, sorry. Contributing.
Yeah, very cool.
I tried, but it failed to create my pool, so.
Uh-huh. Maybe it was already created for the token or something.
I think it was for OMG token, and that wasn't compatible. So
oh, right.
So I think so.
So for anybody who doesn't know, Uniswap is this really, really simple front end for converting Ether into tokens and back. Right? So on Uniswap, it takes something like 3 or 4 clicks to swap ETH for a token. And effectively what you do is you log in with MetaMask, you select how much ETH you want to trade, and you select the token that you want to trade that ETH for, you get a result and you click swap, confirm it on MetaMask, and that's it. So there are hundreds of exchanges. The tokens are priced at a market rate that's determined by all of the trades on the exchange, and the trades are usually completed in less than 30 seconds. And the fee for doing this is 0.3%, so it's very, very competitive. It's very, very speedy, and it's a much better experience than any of the previous generation DEXs. So what's really great about it, right? So there's a ton of DEXs, a ton of places you can do token swaps. Why Uniswap? And I think that the answer to this lies in kind of the crypto economic incentives that it has built in, where you can pool liquidity and make money in addition to trading. And so what's actually happened over the past almost 1 year now is Uniswap has something like 15 million worth of Ether and tokens locked in the protocol. And this is incredible. I mean, really, really jaw-dropping, and is a statement towards kind of the future of DeFi and kind of why we're here today. But I think that the success of Uniswap also has to do with this cycle, this virtuous cycle, where developers have built on it because it's very, very simple to use, very simple to integrate within dApps and applications. Teams have used it to distribute tokens because usually it's very easy to set up pools and have a token distribution platform that's free, that's not controlled by anybody, and that is simple, right? That any of their users can use regardless of where they are in the world. So these developers and teams have built on top of Uniswap, gotten traders to come in and use Uniswap, and as traders swap ETH for tokens, they generate trading fees, which are attractive to liquidity providers. So liquidity providers see the trading fees that they could be earning if they provide liquidity. They add more liquidity, which in turn generates bigger trades, more trading volume, and more incentive for liquidity providers to come in. This example is from the C-DAI market, or the compound DAI market. Liquidity, so the trading sizes, so this chart is showing all of the trades within the market over time, over the last 7 months or so. The greens are buys and the reds are sells. So the market just through quarter 2 really did not have very big trades. It had a bunch of really tiny trades, relatively tiny volume. And the reason for that was that the liquidity was very small, so the pool couldn't support these big trades. But something happened on May 31st, and liquidity increased tenfold. And so we did see bigger trades start happening, and this virtuous cycle kind of playing out where liquidity and providers were more incentivized to add liquidity. Traders were more incentivized to make big trades and generate trading fees. So this is definitely a success story of the platform, and kind of the integration with CDI kind of shows how you can either purchase these CDI tokens on Compound itself, or you can go to Uniswap and purchase them, and it gives a little bit more options and a little bit more distribution, which is great. So the way that this works and what makes Uniswap's product really good, and I think that that's what kind of kicked off its success, has been this concept of peer-to-contract trading. So usually, you have to find another peer to interact with, or you have to submit a bid to an order book or fill a bid on an order book, and there's a multi-step process that's very difficult to complete in low liquidity situations like the current DEXs. So this kind of solves it, and how it works is that each smart contract has a balance of ether and tokens, and the ratio of that balance determines the price that tokens can be purchased at. So if there's a trader, the trader can send ETH and receive tokens in one transaction through the smart contract. And then what happens is after that transaction is complete, the smart contract balances are updated and the price is also updated. So Uniswap uses a different model for pricing, which we'll get into in a few slides. But this is the kind of gist of peer-to-contract trading and kind of what makes it special. So the contract is reset, ready for the next trader after every single trade. And what we can see is kind of price discovery over time with this method. And so you can see the price being set almost perfectly between the buys and sells. When somebody buys tokens, the price of the token goes up. And when somebody sells tokens, the price of the token goes down. The difference that you can see here is actually the fees that are being collected. So this is 0.3% fee. So we're going to get into the bonding curve really quickly, and then I'll go back to that slide. How many of you guys have heard of bonding curves? Okay, that's great. So essentially in a bonding curve, you have some mathematical equation graphed out where the y-axis is tokens in the contract and the x-axis is ether in the contract. And after every single trade, the price of the contract, or the ratio of tokens to ether, must remain on the bonding curve. So for example, if the price starts at 10K tokens per ETH, and somebody makes a trade for 20,000 tokens and 6 ETH, the price in this case would go up to 2,000 tokens per ETH. Right? And likewise, if somebody sells, the price goes back down. So we can see it here, where after a series of purchases, again, the price goes up, and after a series of sells, the price goes down. And the kind of unique thing about bonding curves are that in really big trades, the price goes down much more than in small trades. Right? So that's called slippage. And the price kind of violently adjusts when there's a big trade, and then it's a little bit more gentle when on smaller trades. The kind of reason that this is necessary is because let's say that somebody found a really good price on the contract and they could just arbitrage it right away to a different exchange. They would drain the contract completely, and then there would be no more trading for the traders. There would be no more collecting fees for the liquidity providers. They'd just be kind of stuck at that price. So the bonding curve kind of incentivizes the the price moving on the curve, and every time the price moves on the curve, the liquidity provider is generating fees. But there is kind of a downside to providing liquidity, and that's something called impermanent loss. But it's necessary in order to get the trading fees. So we'll go through those two in order. So liquidity providers have to add an equal amount of ether and tokens based on the price that's already set in the contract. Or if they're creating a new contract, they can set their own price, and then the market can kind of react to that. The sort of thing is that in almost any case, if that asset basket changes price along the bonding curve, the liquidity provider is going to realize or have a loss, right? And so somebody named Pintail generated this chart, and it's perfect for showing the shape of that loss. But for example, if the price of the basket changes, if it doubles or if it halves, if there's a 2x change, there's a 5.7% loss in value. And so what that kind of has to be thought about and played against is the income that's produced by the trading fees. And so in this example, Pintail went a little bit further, and he mapped it as if there were no trading fees in blue, as if there were 11% annual trading fees in red, and then as if there were 22% annual trading fees in yellow. And these are like generally reasonable numbers, and we'll look at what the historical returns have been in markets. But the bottom line is that if you have some level of trading fees, the point at which you break even kind of extends outward. Like you can survive, going down 40% on the value of your basket, or going up to 2.5 times on the value of your basket. So making sure that you are in a market that's generating good trading fees and is not having the price of your basket slipping is really important. Somebody mentioned that being a liquidity provider on Uniswap is kind of like making a straddle bet on the price of Ether, or the price of whatever you're holding in addition to Ether. And so, if the value of your basket drops really far, you have a lot of risk. And equally, if it moves up really far, you have a lot of risk. So the sweet spot is kind of where, you provide liquidity, there's a lot of trading action, and then you take out your liquidity at the same price. If you're looking at on the bonding curve, it would just be, the price would just be bouncing up and down the bonding curve until you get out. And so what we saw at some point in the DAI market, we've seen really negative sentiment and really positive sentiment in the general kind of Ethereum market. And in the DAI market in particular, when the sentiment is overly positive or overly negative, the liquidity starts to dry up, because liquidity providers are actually worried about the price fluctuation giving them impermanent loss. And so they start taking out their liquidity for that reason. And so this is an example of a market where things go really wrong. If you imagine kind of being one of the first liquidity providers to add liquidity at a pretty high price, and then the price just kind of steadily collapses and the value of your tokens goes down, while somebody is selling a bunch of tokens to make the price go down so that the smart contract holds too many low-value tokens and not enough Ether. And this is really the worst case scenario for a liquidity provider. And generally speaking, it's seen on tokens that don't have much demand, tokens that don't have another market where the price can be kept in line by arbitrageurs. So I want to take kind of a quick step and look at identifying front running. So on the previous graph, there was this cluster of dots, and this is kind of like a prime front running pattern, I guess. So what happens on the bonding curve is the front runner buys at a low price? Well, sorry, first of all, a big trader puts in a very, very big trade, and somebody that's listening to the mempool for this transaction before it gets confirmed sees the transaction, inputs their own similar trade, but with a slightly higher gas price. So their transaction is put into the block first at a low price on the bonding curve. Their transaction goes through. Then the kind of whale transaction goes through at a higher price. And then immediately after that transaction goes through, the front runner sells the tokens at a slightly better price than what they paid and kind of profit right here. Recently, Uniswap put in a kind of a control to help mitigate front running, which seems to be helping. So that's really good news. But front running activity definitely exists, and it's definitely, if you're trading in the markets, something to watch out for if you're making a very, very big trade relative to others. So I want to look at growth in some of the kind of top Uniswap exchanges. When looking at growth and looking at return rates and annual percentages and whatever else, I'm not taking into account impermanent loss. To be honest, I ran out of time in preparing, and I'm not 100% sure how to do it properly because the impermanent loss only hits you when you leave a liquidity pool, and it depends on your entry and exit time. So I'm still kind of thinking about that. If you guys have any ideas, I'd love to hear them. So the top performing market quite easily is the DAI market. And what this chart and what this line is looking at is the historical APR on a given day based on kind of the history of the market. So this is the returns of DAI over time. They've been very, very strong, very good. If you don't include impermanent loss. Right? Some of the other markets that have been doing really well lately are Live Peer, Link, USDC, and we'll look at some strategies and kind of interesting baskets of assets on the Uniswap protocol that can be kind of tailored to individual risk profiles. So one of the hard parts and one of the choices to be made about providing liquidity is what metric or what currency do you measure your results in. If you're measuring just in ETH, that's one thing. If you're measuring in USD, that's another thing. If you're measuring in pounds, that's another thing. And so that's kind of a consideration also when providing liquidity. And there's a good tool called Uniswap ROI, I think it's .com or .io, that does a good job at explaining this in a lot of detail and reporting on individual account ROIs, including breaking out the impermanent loss basically in every currency. So one of the strategies I want to look at is using stablecoins. These are really popular, especially if you're comfortable holding a mix of 50% ETH and 50% USD. DAI is easily one of the just one of the best markets, maybe the best market. And what's really interesting about DAI is that you can borrow on Maker with some of your ETH, stay exposed to ETH with that, use your borrowed DAI in this market, and also get the trading fees. Right. So I think that the kind of historical rate of Maker over the past few weeks or few months has been kind of high, but now it's come back down to maybe 15%. So there's kind of an edge there. There are two markets for wrapped ETH, and these provide 100% ETH exposure. So if you're really bullish on ETH and you don't want to swap into DAI and kind of potentially miss out on the price of ETH rising, these are good options. They're not the most kind of these markets don't have the highest volume, but you get that 100% exposure to ETH. minus kind of the smart contract risk of the wrapped wallets or even of Uniswap itself. There are also some wrapped Bitcoin options. I didn't see BTCT, which is a new option, when running this report. But effectively, you can use wrapped Bitcoin and get a 50% Bitcoin and a 50% ETH exposure. So that's another kind of common trading strategy that's possible on Uniswap, where you get the exposure to the assets, but you're also collecting trading fees along the way. In general, these markets, again, don't produce the highest trading volumes, but if what you're after is that exposure, then it's a good deal. So I'm going to pause here for questions or comments or anything like that. I think I'm doing the mic myself today, so I'm going to go close, and then you guys can pass it back.
Hi. What was the front-running mitigation that you mentioned that was introduced recently?
So within Uniswap, you can. Let me see if I have a screenshot of it. Sorry. So within Uniswap, if you press advanced options, you have an option for limit additional price slippage. So it's a little bit confusing because it's a slippage in two places. This slippage refers to what your trade is going to slip along the bottoming curve. In this case, the market is so deep that even 1 ETH trade barely hurts, right? But limited additional price slippage just effectively allows you to say, if anyone comes and tries to front run me for more than 1%, then I want the trade to fail and the transaction to fail. So you pay just a tiny bit of gas in that case. But there is a warning that says, your trade might fail. Like, for example, if someone else's trade goes in front of you and you miss the maximum price you're willing to pay. But I think that only applies in really, really liquid markets, like maybe the DAI market, for example, or whatever the case is.
Hello. I have been investing in Uniswap for 5 months, and I want to ask you about a specific issue every time you are adding liquidity or fees to the liquidity pool. But if you assume that you are always putting the same trading fees, it's not the same to buy when it's in the dip or when the two assets are too low.
Yeah.
So in some case, I have seen some profit from buying or incorporating these fees in the low value assets. So what do you have considered these kind of things, or because every time you are really adding fees to the liquidity pool, but not at the same price?
Yeah. So I've looked at so for the graphs that I showed you, I filtered them by having a certain amount of liquidity, and then smooth them out by enforcing a certain amount of trades for the points to show up. And so in reality, what happens, especially in the low liquidity pools, is that the returns are kind of all over the place, depending on if somebody made a big trade that day or whatever the case is. Yeah.
But the thing is, every time you add fee to the liquidity pool, you have to buy Ethereum or Bitcoin. If they have fall a lot, you buy more ETH or Bitcoin to the pool than if you will be in the top. So you have some revenue from this kind of adding fees to your return.
Yeah, it does make sense, but I think that it can go. It's deceptive in a way because the impermanent loss can affect you even if as opportunity cost. So let's say that you had 100% ETH, you used 50% of it to buy DAI, and then the price of ETH went up. Now you missed out on, with 50% of kind of your bankroll, you missed out on the price of ETH going up, right? So if you had only held ETH, it might have been slightly better than having the basket. And those charts, again, just kind of depend on how much the price has moved and how much in trading fees the pool is generating. Uniswap ROI is like a great resource to look into that more.
Does the pool ever run out sort of one way? So you end up with all the ETH and no DAI, and then you have to refill. Does that happen, or?
So the curve is like I think it's called asymmetric or anyway, whatever it is. The curve never touches the axis, so like technically no, but in reality what happens is it like gets whittled down and then somebody just pulls out their last liquidity.
Could you explain what's the goal of wrapping Ether for Uniswap? I mean, Ether is already the underlying.
So there's a few dApps that require wrapped Ether to work nicely with their dApps. So I think 0x is one, Augur is one. They have the Cash App.
Yes, but they can wrap the Ether for you. So you send the Ether to them and they wrap it. You don't need to trade it.
Yeah, I think that this might be slightly easier, and people just take the easy option, or it may be that the price is sometimes good or bad. I'm not sure, to be honest. We could look up the market if you want.
I think it's because there are some like pretty naive arbitrage bots that are just enumerating all Uniswap markets and then trying to find like multi-step arbitrage, and they don't know about the ability to wrap Ether because there happens to be a Uniswap.
Okay, for me, it sounds like it's a tool for somebody who just wants to play more.
It doesn't really make a lot of sense.
It's basically just ERC20 interface compatibility, right?
Yes,
but why you need a Uniswap for that? That's the question.
Easy DApp integration.
Yeah. It also allows smart contracts to make transactions on behalf of users, and so I think, you know, even if it's not a user directly pressing the button, it may be a smart contract just doing it for somebody else. Yeah.
Yeah, I think that they wrapped it in order to have the same interface with the other ERC20 tokens and to have some consistency in order of development.
Yeah.
So my question is, when we have Compound and some other, for example, ETHLend and some other lending and borrowing platforms, do you think that this could take some of the liquidity that will be removed from Uniswap and go to some of these protocols? Because if I have some big amount of DAI or ETH, probably I will decide to put it in Compound and to take between 10 and 12% yearly, rather than putting it in Uniswap. But at the same time, if people are clever enough, they will put some liquidity in Uniswap because at the end they need the liquidity and to trade somewhere. But yeah, I think this could be a problem in the future.
When Maker originally raised their rates to like near 19 and 20% a few months ago, the overall liquidity in the DAI market started to like go down in huge chunks. You know, we could see that these guys are going back and like repaying their Maker loans and choosing not to participate in the DAI market anymore. So I think that these external changes to the market actually do have an impact on it, and what tokens are available or what rates are available on other DeFi platforms are absolutely having an impact. You know, we saw the growth chart, and then it kind of hits, you know, 17 million and then drops back down to $15 million. Some of that is based on the price of ETH, but some of it is also that there's great alternatives coming out. And so in terms of making money, this is not the only alternative. There are a ton of them depending on kind of what your strategy or goal is. Yeah.
Do you think that this kind of pools can stake a lot of the tokens of one project because they are incrementing all the time? If they don't quit the equity, they are going to add more in the future.
Yeah.
Because I think if they are going to profit from 3% or 5%, I don't know, will be the cost of capital to let the capital there. But I think there are a lot of pools that are growing, and they will have an impact also in the token because there's like a staking So what do you think about this kind of process of
Yeah.
having more staking tokens in the?
I think that once a pool gets extremely deep, it actually starts becoming hard to adjust the price, and it starts, people start maybe avoiding it even if the price is bad relative to other exchanges. So I think that there's a case where, depending on what the demand of the token is amongst traders, there can be kind of a pool that's too deep. We haven't really hit it. The DAI pool is extremely popular. There's a huge demand for DAI. But there are some other platforms that are utilizing smart contract trading, and they have kind of hit that cap where moving the price is very difficult.
I really like Uniswap because it's extremely simple and you can embed it anywhere. But do you think that you can keep that simplicity and implement Uniswap in different blockchains to be multi-chain, not only Ethereum based?
So Bancor is doing it, right?
It's kind of doing it, but it have a middleman token which
Yeah.
is not that decentralized.
Right. So they have a bridge or whatever, and right. So I kind of like their solution. They're just figuring out how much of this token is on each chain, and it's kind of cool to have that interoperability, even if it does come with the guardhouse, right? I think in the future there will be more opportunities for pooling liquidity and more attractive opportunities for pooling liquidity. This is really the first version. Right now, what's almost flawed with Uniswap is actually starting the pools. It's an extremely altruistic activity to start pools, and should probably really only be done by huge bag holders who need to generate a market, or teams that want to distribute their tokens more effectively, or whatever the case is. And so this is kind of one of the biggest challenges, and I think that potentially bonding curves that change shape depending on the depth of the pool might work, or something of that nature. But Bancor just announced all this yesterday, and so the version 2 of smart contract trading is coming, which is going to be great. And I know that Uniswap is also working on version 2, so there's a lot of great movement there. Yeah.
What is coming in the version 2?
I believe stablecoins as a base pair, which really helps with impermanent loss. Bancor announced the same thing. So we'll kind of see how that goes, and hopefully by the time those launch, I actually have a reliable method of calculating impermanent loss.
What would be the difference, like if both of them were based on a stablecoin? What would be the difference between Uniswap and Bancor?
Which stablecoin they used? Right, so Bancor will use Bancor stablecoin. Uniswap probably use DAI. Yeah.
Wait, I'm sorry, Bancor has a stablecoin?
It's been announced yesterday or something. Yeah.
What do you think is the disruptive power between Bancor, Kyber? What do you think about the competition about the three?
Yeah, so I want to show you a market, right? And effectively, this shows all the trades for today. There haven't been many. But within this market, the trades that are trading WETH for ETH are coming through Nuo account. Actually, 3 Nuo accounts. So Nuo is pushing a lot of the traffic for wrapped ETH to ETH. And then in other markets, you see Kyber has a huge presence in the market. And then even exchange aggregators like One-Inch.Exchange and some other ones also are sending trades through to Uniswap. So I don't necessarily think I think that users just want the best price. And so even if there are multiple pools to get it, I think that aggregators will kind of take care of it. And then the pool operators and the people who develop the pools can make the the differences that they need to make specific to kind of who they want their users to be and how they want their experience to be. So I think that the future is really bright for smart contract trading. It's incredible to see like really massive trades from 1inch.exchange kind of being fed through 5 different DEXs, all like, you know, perfectly aligned to just reduce slippage to almost nothing. I mean, at this point, I kind of feel like for certain markets, the DEX opportunities or the DEXs that are available are equivalent or better than the centralized exchanges like Binance and these other ones.
Is this dashboard available for everyone to view, or is that just private?
It will be, yeah. I was kind of hoping to get it done today, but it didn't work out. Yeah. Thank you guys very much. Thank you.